How do you perceive the resiliency of stock market in Asia and also emerging markets in line with the trend of high interest rates? Is it still interesting or appealing, or investors just tend to wait for this stormy era of high interest rates to subside?
Well, it's not only interesting and attractive, it's the most attractive set of equities to be buying globally. You want to be focused on emerging markets. And what we see right now is you can buy the emerging markets index today in 2023 at 2007 prices, 16 years ago, despite all the increase in GDP in the emerging markets. So historically, emerging markets equities will trade opposite to the US dollar. When the dollar stops going up and starts coming down, as it did in 2002, 2009, 2016, and 2020, that's when you see monster rallies in emerging market equities, which you're starting to see right now. So just like we saw in 2001 to 2002, the dollar started coming down, and what you saw was emerging markets rallied 480% from 2002 to 2007. The same thing happened from 2009 to 2011. The dollar started coming down off of big time strength. And in those 2 years, emerging market equities rallied 189%. The same thing happened from 2016 to 2018. Dollar weakened. Emerging markets was up 100% in those 2 years. And then the same thing in 2020 to 2021. Dollar weakened and emerging markets equities were up 97%. So this will certainly be the best trade over the next couple of years. The dollar has now fallen almost 10% in the last couple of months, and that's why you're seeing the bid in emerging market equities, irrespective of interest rates. And I think people are underestimating still the impact of China's abrupt reopening and dropping of the zero COVID policy. They've done an about face on the internet platforms. They're now supporting the internet platforms. That's attracting foreign investment back into emerging markets, of which China is close to 40% weight. And the Chinese government just in the last couple of weeks set their GDP target for 2023 at 5%. I think the world is underestimating the impact. This economy has basically been closed for 2 years. And when the second largest economy in the world sets a 5% GDP target, and they can actually meet it now because the people are free and they're out from zero COVID and can go about their activity, I think a rising tide is going to lift all boats, not only in the developed markets, but in all of the emerging markets. And that's exactly where you want to be right now moving forward. And then the last thing is that China can continue with aggressive stimulus because they have fewer inflation worries. They've been stocking up energy from Russia at $60 a barrel. So they can do fiscal stimulus, they can do monetary stimulus. Unlike the developed world, who's worried about inflation, their fiscal and monetary stimulus is more in a tightening mode versus an easing mode. And that's why you want to take advantage of emerging markets over the next few years. And we're very, very positive on the outlook for that asset class.
Okay, so investors might consider the impact of reopening economy in China also. Thomas, do you think there is a rebalancing portfolio from stock market to bond market? What about the prospect of bond market in the midst of global uncertainty and the threat of recession that will hit 1/3 of the world's country, as currently there is an inverted yield curve in US bonds?
Yeah, this is a trap. A lot of people are looking at the nominal yield on bonds and saying, wow, if I can get 5% or in this case, 4% on 2-year treasuries, and I don't have to take any risk, that's great. But what they don't realize is they're taking huge risks because inflation, even though the Fed is talking 2%, what they're trying to do is pin long-term inflation expectations. Inflation is going to run 3 to 5% for the next 3 to 5 years. Just like it did after World War II, when our debt to GDP was 120%, just like it is today. They have to run inflation above trend in order to bring that ratio down. In 1948 to 1953, they brought debt to GDP down from 120% down to 63% by running inflation above trend. And if you have 4 or even 5% in short-term bonds, you may think you're getting a good deal. But if, let's say, your yield is 4.2%, close to what it is on the 2-year yield right now, but inflation is still running, 3 to 5%, call it 4%, your real return is 0, and inflation is, still running hot. So what we've seen historically is the best hedge for inflation is high quality equities that have pricing power. If you look at Coca-Cola, for instance, last year alone, every single year they raise the price of their syrup that they give to restaurants for the fountains, et cetera. They raised their product prices 4 to 8%, depending on the category, just last year alone. So that's going to be your better hedge against inflation, is buying high quality equities that have a brand moat that can increase the price of their products, and the customers will take those prices moving forward. So we think there's a lot of opportunity with high quality equities. That's going to be a much better hedge for any type of inflation than bonds will be. Bonds is an illusion. The nominal yield looks high, but adjusted for inflation, you're not going to get much on your money. You might get a short-term peace of mind, but with bonds up and equities down, the opportunity now is to buy equities, and in particular, emerging market equities. As the dollar weakens, those are going to dramatically outperform any inflation in the near and intermediate terms.